Hello, welcome to my channel. Today we are looking at mediating variables in accounting and finance research using Stata. What is a mediating variable, or what are mediating variables? Basically, when we talk about mediation, it is actually a statistical concept employed to investigate and explain the way by which one variable exerts impact on another via or through a third variable, commonly referred to as the mediator. The understanding of the indirect effect that influence relationship between variables is of utmost importance in diverse domains such as finance, psychology, and social sciences. So with that background, we'll go into applying how do we run mediation in finance and accounting research. We are looking at mediating effects of equity debt ratio on dividend per share TobinsQ relationship. The effect. What is the mediating role? What we are saying is the mediating effect or mediating role of debt to equity ratio on DPS TobinsQ relationship. What we are saying is, or the hypothesis could be, is dividend, is equity to debt ratio able to mediate between dividend per share and Tobin's Q. So that is what we're going to use to demonstrate the mediating effect concepts. When we talk about mediation, as you can see in the diagram below, you have the dividend per share and you have the equity debt ratio and you have the Tobin's Q. There is the part from dividend per share to EDR is a direct part. That's equity debt ratio, and the part from EDR to TobinsQ is a direct part. That is the direct effect of equity to debt ratio on TobinsQ is on B, while the direct effect of a dividend per share on equity to debt ratio is on part A. And lastly, the parts of a dividend per share on TobinsQ is a direct effect. The direct effect of a dividend per share on TobinsQ is on the part of C. That is the direct effect. But when we are talking about mediation, we'll be looking at the indirect effect of dividend per share on TobinsQ through the part of EDR. That is, dividend per share moves to, impart on equity debt ratio, and from equity debt ratio, it follows the part to impart TobinsQ. That means the indirect effect is that dividend per share has to go through EDR in order to impart on TobinsQ. That is the indirect effect. The direct effect is on part C. That's dividend per share DPS on TobinsQ is on part C, as we can see. So when we talk about mediation, Mediation is actually looking at the indirect effect. Is dividend per share, or let's call it is dividend policy, proxy by dividend per share, um, does it have an indirect part through equity to debt ratio on TobinsQ? That is, we are trying to check the mediating role of EDR, the mediating role of leverage proxy by equity debt ratio. Will dividend per share, does it have any indirect? One will combine this factor together. Is dividend per share able to garner some indirect impacts on TobinsQ? That is what mediation is about in finance. So we will dive deeper into this. Going into Stata, we are going to do some practical illustration of this and actually test the hypothesis whether there is a mediating role that EDR play in the relationship between dividend per share and TobinsQ. My data is already loaded in Stata. We are still working with the consumer goods sector data that I've used in previous video. So, for us to run for us to analyze the mediating effect, we need to actually use the SEM, that's a structural equation model. So we go through the menu and go for the model building and estimation. Model building and estimation. Recall that we are actually looking at the mediating effect of a equity debt ratio on dividend per share TobinsQ relationship. So that is what that is. We can say that we want to hypothesize that dividend policy proxy by dividend per share has an indirect effect or an indirect impact on TobinsQ through equity debt ratio. That is our working hypothesis. So we'll go into Stata, we'll go into to the statistics and select a structural equation model. From there, we'll select model building and estimation. Recall that our data is already in the system. So building the equation model. Now I'll select the observed variable because the variables I'm working with, they actually observe. They are not latent variables. And for this example, we are only using three variables. For the first example. Hopefully we'll be able to expand it further. So I have three variables identified. I need to establish the relationship between the variables. So this is the directional part. The implication now, the arrow is facing this, meaning that this box is where the independent variable is, and the second box is where the dependent variable is. And if another part moves from here to this, it means this is the third box is a dependent variable. And in a structural equation model, the term actually, the term used basically are between the exogenous and endogenous variable. The exogenous variable is equivalent to independent variable. So let's go for independent variable. I need to make this an independent variable. Our independent variable is the dividend per share. I need to select that. So to the variable list, dividend per share DPS. So that is the first independent variable. So we'll select the second variable, which is our mediating variable. That is equity debt ratio. Equity debt ratio is our mediating variable, which is also an endogenous variable. So the next endogenous variable will be TobinsQ. TobinsQ, we need to select TobinsQ from the variable list. TobinsQ, that is the next endogenous variable. We need to create another part. We have created the direct part of a DPS on EDR and the direct part of EDR on TobinsQ. So we need to create the direct part of DPS on TobinsQ. So that has been created. So all the parts are now complete. What we are saying now is dividend per share has a direct impact on equity debt ratio. That's a direct part. Another direct part is the equity debt ratio on TobinsQ. And the third direct part is a dividend per share on TobinsQ. While the only indirect part here is the parts dividend per share goes through EDR to impart on TobinsQ. That will be the indirect part. Now that we have drawn the path diagram, we can then estimate by clicking on estimate. Now we'll go with the default maximum likelihood, and we'll also let's use the default standard error for this regression. So if you're okay with that, I click on I'll click on that and the regression will be run there. But I want us to see. Yes, if I click on that, the regression will be run. 1 minute. Now estimate the maximum likelihood is selected, and we are on default standard error. Once I click, the structural equation model runs. So that is it. We now have the structural equation model. The first step, we can see the number of observation, 160 observation. And if you move down to the first in the structure, you have TobinsQ is the dependent variable, which is called the what's it called? Endogenous variable here, being impacted by the EDR, equity debt ratio, and dividend per share. What is the p-value? Equity debt ratio has a negative coefficient and a non-significant p-value, because the p-value is greater than 0.05%. So that means that part is not significant. And if you look at the part of dividend per share on TobinsQ, it has a positive coefficient of 0.11372, and it is highly significant at 0.01%. So dividend per share has highly significant impact on TobinsQ. So if we move to the second part of the equation, we have the impact of dividend per share on equity to debt ratio. Is this part significant? It's positive. It has a positive coefficient, but the p-value is greater than 0.05. So at this point, the impact of a dividend per share of a dividend per share on equity to debt ratio is insignificant. So that's the that's just a summary of this regression table. But where we are going is for us to be able to establish the indirect effect. Is equity to debt ratio able to, is a dividend per share able to impart on TobinsQ through the pathway of equity to debt ratio. For that, we'll go to statistics and look for direct and indirect effect analysis. So we'll carry out a direct and indirect effect. So the composition of effect into total, direct, and indirect effects. So I go with default value. I click OK. So this is the further analysis. Since there's only one indirect part, which is the part of a dividend per share through equity debt ratio on TobinsQ, and that is the part we want to examine. Is it significant? It has a negative coefficient of minus 0.011,269, and it has a p-value of 0.444, which means this pathway is not significant. So we can say that dividend per share is, equity debt ratio is not able to mediate the relationship between dividend per share and Tobin's Q. The indirect effect is insignificant. So I want us to quickly try another one. Let's juxtapose this. Let's drop the equity to debt ratio and bring in another variable. I want us to bring in the ROA as a variable. Whether ROA will be able to mediate in this relationship. ROA, I've dropped equity to debt ratio, and we want to estimate now the regression. Now we are saying dividend per share, ROA, and TobinsQ. So the hypothesis is that ROA has a mediating effect on the relationship between dividend per share and TobinsQ. So we'll estimate the regression now. Go to estimate. We'll use a default value, maximum likelihood, and standard error. So I click on OK. So for this second hypothesis, what do we see? Now, the same number of observation for the pathway of on TobinsQ, that's ROA on TobinsQ, and dividend per share on TobinsQ, that's the direct part. For ROA on TobinsQ, it has a positive coefficient and highly significant at 0.00%. This is to say that ROA has a highly significant direct effect on TobinsQ. Now, for dividend per share, it has also a positive coefficient and highly significant p-value, because the p-value is 0.00%. So dividend per share has highly positive or significant effect on TobinsQ. So let's move to the second segment of the pathway. Now we are looking at ROA as a dependent variable and dividend per share as the independent variable, having a direct part on the ROA. The direct part on ROA, the coefficient is significant, and the p-value is also, is also highly significant. This means that dividend per share has a highly positive impact on ROA. So the next thing for us is to, let's quickly test or decompose this relationship to know the direct and indirect effect. So I'll click on the start total effect. That's the command, enter. So this is decomposed into 3 segments. The direct effect segment. On the direct effect, which we have actually analyzed in the earlier part, this is the direct effect of ROA on TobinsQ and DPS on TobinsQ. Both of them are highly positive. Highly positive. Sorry, they are highly significant and positive. ROA, dividend per share on ROA is also positive and highly significant at 0.00%. Coming to the indirect effect. On the indirect effect, there's only one indirect pathway, and that's the DPS on TobinsQ through ROA. So what's the part? The part coefficient is positive at 0.026446, and the p-value is highly significant. So we can conclude that the ROA is able to mediate the relationship between dividend per share and TobinsQ in a positive and highly significant manner. That is, ROA is playing that positive and highly significant indirect effect on the relationship between dividend per share and TobinsQ. So that is the indirect effect. The total effect of dividend per share on TobinsQ is now on the total effect. If you look at the coefficient of dividend per share, the coefficient of dividend per share is now 0.1125, and it's positive and highly significant. The coefficient of the indirect coefficient of a dividend per share on TobinsQ is actually that's 0.0264. If you add 0.0264 plus the indirect effect plus the direct effect, which is 0.0861573, the summation of those two, the direct and indirect effect, will give us the total effect coefficient, which is 0.1125. Let me try and make that addition. Calculator. Sorry. No, that's the direct effect. Cancel. Let me pick the indirect effect. Indirect effect paste plus direct effect of DPS on TobinsQ. That's the direct effect. Pick the value, copy calculator, that's plus this equals to, yeah, that's it. So you can see that the addition of the direct and indirect effect give us the coefficient of the total effect, which is 11, that is 0.1125. Let's see, that's the under the total effect, the coefficient of a dividend per share is 0.1125979, which is what we have in the calculator now. That's 0.1125979. That give us the total effect of dividend per share on TobinsQ. On a direct effect basis, it has a total effect of 0.0861573, and on indirect basis, it has a 0.0264406. The two combined will now gives us a total effect of dividend per share on TobinsQ. This is how mediation. This is a simple example of how mediation can be applied in finance and accounting. So what that in summary says is that dividend per share has direct positive effect on TobinsQ. Not only that, it also has an indirect positive effect on TobinsQ through the pathway of ROA. So that is how to run mediation analysis in finance and accounting using a Stata software. I hope this will help us in our research. If you have questions, clarification, we can always reach out. You can make your comments. Do not forget to like and subscribe to this channel. Thank you.